Well, good afternoon, ladies and gentlemen. Of course, I say good afternoon for those of you who are joining me, I should say, on the East Coast. I'll say good morning to those of you who might be joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. And I'll also say good evening to those of you who might be joining us from across the pond out in the UK or Europe, or good evening or good early morning to those of you who might be joining us from Australia or parts of Asia. Welcome to today's presentation. I don't know if anyone had any issues at the beginning of the presentation. I saw that Kurt had started the webinar, but I wonder if he was actually doing I apologize if he was testing something on his computer, and then when we logged on to start the presentation at 12 o'clock, or right before 12 o'clock, that might have kicked everyone off. So I apologize for that. I'm not sure exactly what happened. I think Kurt's trying to log back onto the webinar right now. He's not with us, but we're going to go ahead and get started because we are at the 12 o'clock hour. Now, in today's presentation, we are going to discuss the radioactive trading setup. We're going to talk about the solution that faces, the solution to the problem that faces most investors as they go through to trade their positions. And we're also going to share two nested spread trades. And most likely what we'll be looking at today, if we don't see Kurt in a few moments, is when we're look at just some simple examples of income method number 1 and income method number 4 from the silver Wheaton trade last year. Of course, income method number 1, fairly common adjustment. It's given away for free in the sketch, but it's also discussed in more detail in the blueprint. There are certain rules you have to follow it. And income method number 4 is a unique way to reposition your protected trade, your protected stock position, in order to get the benefit of a higher potential payout and potentially bulletproof the position. But we'll get to that in just a little bit. Now, before I jump in and I introduce Kurt and myself, I hope Kurt comes in so that he'll be able to introduce himself. What I'd like to do is run a couple of polls and just get to know the attendees a little bit better. And the first thing I'd like to know is, how did you find out about radioactive trading, about the concepts of the blueprint, the radioactive trading? Did you hear about it from a friend? Were you looking on a web search to search for maybe protective positions or the radioactive trading? Have you gone through some of the forums or some of the open forum trading forums that are available? Are you a current subscriber or free trial member of Power Options, and that's how you heard about radioactive trading? Or did you hear Kurt or one of our other members guest speak at a presentation across the country, a small seminar perhaps, or guest speaking on an online webinar through a different group? So just let me know. We'll leave this poll open for another 10 or 15 seconds. Just want to know how you heard about radioactive trading. Okay, so we'll leave this open for about another 5 seconds here. If you haven't voted, I encourage you to go ahead and just let us know a little bit about you. All right, let me go ahead and close that poll, and we will quickly share the results with the audience. It looks like we have about 17% of our audience were told about radioactive trading through a friend. 33% found out radioactive trading through a web search. 0% from the forums, of course, and about 50% of you are current subscribers to Power Options. So those of you that are currently with Power Options are probably familiar with my voice from different archived webinars or coaching sessions perhaps as well, and it's great to see you all here, of course. Let's go ahead and hide that, and very quickly I'm just going to launch a second poll, and this will help me gear the presentation. I would just like to know what kind of options trading are you doing right now? If you've recently, I should say, been burned with options, or you had a bad experience when you first started out, just let me know. Select options me no likey. Are you currently looking at covered calls or naked put positions? Are you trading long calls and puts? Are you currently doing spread trades or combinations like perhaps calendar spreads or even iron condors, for example? Or are you looking at the naked calls, for example? Okay, we're going to leave this poll open for just a little bit longer here. About another 15 seconds, so if you haven't voted, I encourage you to go ahead and get your vote in. Okay, so let's go ahead and close that poll. Oh, a couple more votes coming in. Leave this open for another 5 seconds. 4, 3, 2, and 1. Let's go ahead and close that poll, and we'll share the results. Looks like a even digit split here. Oh, I'm sorry. 10% currently options mean no likey, and that's an unfortunate thing. It's something that we hope to change. Yeah, the 10% of you who answered that you currently do not like options trading is that you might have been shown a couple of ways or been promised a couple of ways to make money, or heard about maybe making 3 to 6% per month, or maybe 10% doing spread trades, and you tried to implement that after you paid $3,000 to attend a weekend seminar, only to find out that the downside or the risk involved was never addressed, and you found yourself losing more money than you were making. And we're going to show you some ways you can hopefully prevent that in the future. 30% of you are doing covered calls, and 30% of you are doing long calls and long puts. And then we have 7% doing spread trades and combinations. Okay, so we have more people doing spread trades, so I might actually do a different presentation, or sort of a different, select different income methods than the silver Wheaton trade I was going to do. Let's see if I can pull up something later on when we get to that point to go along with some of the spread trades, as Kurt had mentioned in the webinar, spread trades done at no risk. Okay, so we might do a little bit of adjustment there. All right, well, let's go ahead and hide that and move on. Now, do I have a slide here for Kurt? For us ourselves, Kurt Frankenberg is the author of The Blueprint and the founder of Radioactive Trading. Kurt founded Radioactive Trading about 11 years ago, around 2000, 2001. Like many of you, Kurt, how many of you might have gotten started, Kurt had paid a couple $1,000s to attend a weekend seminar to learn how to do covered calls, spread trades, and calendar spreads. And he went out to implement what he had learned from his trading guru after the 2-day session, because after, of course, you pay a couple $1,000s and attend a seminar for 2 days, you're obviously going to be an expert on how to trade certain strategies. Well, that's not always the case. And what happened to Kurt is for the first 2 months, he had very good success trading those positions, and his guru told him, well, you can enhance that. Why don't you just go ahead and trade on margin? And also, you look at some of these stocks that offer a higher premium. So Kurt did that. He entered a covered call trade on margin on a very volatile stock. He had the potential, I believe, to make around 15% return on a 30 to 45-day trade. But of course, as he watched, the stock completely collapsed, and he got a margin call, and he essentially ended up losing most of what he had put aside to start trading, including, of course, all of the profits that he had made in those first 2 months. Now, most of you who started out with covered calls or started out that way of investing, I doubt you went right into spread trades from the beginning. But most of you, and myself included, I started with covered calls, and I saw very quickly that I would not want to trade them on margin. But Kurt was told by his guru that that's what he should do, and that's what he implemented, and it came back to haunt him. But the point is that Kurt's story, unfortunately, in the past 8 years I've been working with power options, is not limited. I've heard of so many people who start off with doing certain strategies that end up losing most of the money they had set aside for trading within a very short time, or they suffered large losses, and this might fall into that the 10% who answered options mean no likey. Now, what Kurt did is, instead of giving up, he went back and he started researching different option strategies. And he decided that he was never again going to enter a position where he was risking so much capital that it could wipe out 10 to 12 or 15 previous gains based on what happened to the position. And what Kurt developed was this simple technique, but set up in a unique way, to enter into long stock positions, to take advantage of the long stock movement, long stock growth, and other adjustments that can be made, but making sure he was only risking single digits at any given time. Now, Kurt hopefully will still be joining us at some point during this presentation. I guess he's having some computer issues, and I do apologize for that. But my name is Mike Shupka. I'm the Director of Education here at Power Options. And Power Options is a patented suite of search and analysis tools designed for self-directed options investors. And we support over 23 different strategies. Now, I got hooked up with Kurt about 3.5 years ago. Kurt was a subscriber to Power Options, and he called up for a coaching session to learn how to do the back testing, the historical back testing, to implement or identify positions on his trading. And I walked him through how to do that, and but while I was looking at it, I told him I was concerned. I didn't see how he was going to make money with this particular setup, just due to the fact that it looked like he was going to need a large growth. And we'll look at that in a minute. He was going to need a large rise in the stock price in order to profit on the position. Of course, Kurt invited me to attend his free webinars, as you're doing right now, and he was going to show me exactly how he makes money with this setup. So I joined him for his free presentation, And I was so impressed with the technique that I invited Ernie Zarrenner, the president and founder of Power Options, to join me for the next presentation. And Ernie was so impressed with it that he decided to partner up with Kurt, and we've enhanced our tools on Power Options to work specifically with Kurt's techniques, as well as the other 23 strategies that we support. All right, but let's move on. What we're going to do in this webinar is we're going to show you a simple truth and a principle that successful traders have said over and over, the problem that faces standard investors, and we're going to talk about the simple way to solve that problem. Okay? At the same time, what we're going to do is show 2 of the 10 different income methods that Kurt uses to adjust the risk after the initial setup, and if we have time, we may even discuss some other principles as well. Many of you have heard this axiom, of course. This is a popular axiom that's discussed by many successful traders and many of the popular traders that you read about, Warren Buffett and so forth. The popular axiom to be successful in trading, of course, is to cut our losers short and to let our winners run. Now, this sounds like a simple process. It sounds a lot like buy low and sell high, but the problem is we don't always do this. When we look at some different strategies, such as covered calls, naked puts, typically the strategies that you're allowed to trade once you get started, the basic setup of those 2 positions of covered calls and naked puts don't allow us really to put this into practice. The basic setup of the profit and loss chart of a covered call, when you just look at it in general, it really is focusing on cutting our winners short and allowing our losers to run unless we put in more capital to potentially make an adjustment or roll down to try to minimize the loss, which we'll never be able to keep up with the decline in the stock, if the stock declines more than 10 or 15%. Now, what we're going to do is show Kurt's initial RPM setup, what he developed back about 10 years ago, 11 years ago, after he had suffered his declines trading covered calls. We're going to show a setup that allows you to put this into practice, this cut your losers short and let your winners run, into immediate practice. And that particular setup, we're going to show how that will instantly improve your trading results. Now, with the basic setup itself, let's move on past this. The basic setup itself, how we're pretty confident that it's going to be able to help you instantly improve your trading results. So I'm just going to move past some of this because I just want to get into the nitty-gritty here, so I apologize for this. This is an older presentation here that I don't have the updated one. Let's see here. Okay, but what I wanted to do first is, we had mentioned, I apologize, that we were going to look at how this can instantly improve your trading results. And we're going to launch another poll very quickly. And what we would like to know is, are you happy with your trading results over the last 12 months? Are you satisfied with your trading over the last 12 months? Are you happy with your trading results but could stand to be happier? Do you have mixed emotions? Essentially, you've won some but lost some. Are you unhappy with your trading results over the last 12 months? Or are you essentially ready to quit due to some of the losses that you've taken? So just let us know how you feel about your trading over the last 12 months. Okay, and I'm going to leave this poll open for about another 10 or 15 seconds. So if you haven't voted, I encourage you to do so. All right. Some more votes coming in. Okay, now this is essentially what we tend to see on this type of format, where we tend to see a substantial or a significant bell curve set up on these results. Let me go ahead and close that. Now, we've had it open for about a minute, and we're going to go ahead and share those results. And this is just a baseline reading. And typically what we do see here is whenever we run this poll, what we've been doing for the past 3.5 years when Kurt runs this poll, we essentially see this type of bell curve. And on average, we see about a 20 to 80 split. And this one's a little bit better. Now, we only see 5% of you that are really satisfied with your trading results over the last 12 months, and that's what we want to try to correct. 21% of you are happy, but you could stand to be happier, and that's good. We're going to have a solution for you as well. What we're going to give away for free in this presentation is probably going to help you as well improve your trading results. Now, 58% of you have mixed emotions. You've won some, but you lost some. I had the same exact experience. When I first started trading, I first learned in investing about 8.5 years ago. I started off with covered calls and moved into naked puts, which have the same risk-reward profile. And I had the same experience. I had some really successful trades, some good months making 3 to 4%, but then I'd suddenly have one bad trade or two bad trades in a month that would take out the gains that I'd make in the previous 3 months. You take 3 steps forward and 1 step back, and you're at square one again. Now, we're not poking fun because I've gone through this as well, but mixed emotions is really code for no. If we were happy, we would have said we were happy, but the mixed emotions here are really saying no. 11% of you are downright unhappy with your trading results just over the last 12 months. 5% of you are considering just quitting. Now, what we see here is typically what's referred to as the Pareto split, where we have, if we take the 58%, the 11% that were unhappy, and the 5%, well, what we're looking at there is essentially 74% of you are unhappy with your trading results, and 26% are happy or you're ecstatic, but about 21% of you in additional could stand to be happier. But what we're looking at here is almost an 80-20 split, the Pareto split. In this case, it happens to be 74 to 26. And what we're going to show today, we feel confident in, and we also hope that it's going to instantly help your trading results, and we're going to take a look at that in a little bit later. Well, all right, as I was talking about before, and those of you online, of course, are very familiar with this basic setup. We did have 10% saying options, that they currently don't like trading options. You may be just getting started, or you may have had some losses. But most likely everyone here is familiar with this setup. The covered call trade, which is typically what you're allowed to do as a level 1 trader, when you first tell your broker that you want to start trading options, at the beginning they'll just maybe qualify you for level 1 trading, which will allow you to do covered calls, and depending on your broker might allow you to buy calls as well. Now, what we had to do with the covered call is we're going to be long stock. So we're buying shares of stock, and that is the main proponent of our holding, so it is a bullish setup. And we're going to sell a call against it, generate some premium, which limits our risk a little bit. If we generate 4 or 5% of premium or 3% of premium, that's going to give us about a little bit of a 3%, 4% protection before we hit the break-even point. Well, that helps, but it doesn't help if the stock drops 20 or 25% overnight. Still haven't effectively limited our risks. Now, the problem is a lot of brokers will recognize that this is a bullish position, and they'll say that the risk is safer. Well, we don't agree with that. It's safer compared to just owning stock. But if you notice on the profit and loss chart, what we've done here is we have cut our winners short, but we're still allowing our losers to run. If I enter in a position that has some very bad news, or they've been falsifying the books, I enter a covered call position where I generated 3% potential return, well, I'm still on the hook for 97% of what I invested in the worst case scenario. If the stock goes into bankruptcy, that is an issue. And that's what very rarely happens, but I have seen it happen over the past. But what I've seen more frequently happen in the past is overnight gaps, or even today, this morning, coming into the market after a 3-day holiday, and more news comes out about EU debt, for example, and about the jobs report here in the U.S., and the stocks fall in the morning another 3, 4, 5%. Now, that's might be manageable with that kind of decline. More often than not, we're seeing stocks drop 10%, 15%, 20%, bad earnings and other reports in a more volatile market, and you're still on the hook for most of that with the covered call. Now, the reward is limited. That is very true. But this is backwards from our basic axiom that we want to follow of cut our losers short, let our winners run, or buy low, sell high, if you wanted to look at it that way. So the covered call doesn't satisfy our requirements. Now let me fast forward through this. I already talked about this. This was the situation that Kurt was in, where he ended up going into margin on his particular, using margin, following his guru's advice. And then after that, what Kurt decided to do is further research a position. And what he decided to do is, following that axiom of cut our losers short and let our winners run, he started looking at the profit and loss charts of different options positions. And many of you look at this and say, well, oh, that looks like just buying a long call. Well, Kurt looked at that too, but there are some drawbacks to a long call position that need to be addressed that we do address in the blueprint and in the blogs, and we can even take a look at it later today if you would so like. But Kurt's proposition, after he lost a lot of money doing the covered call setup and looking at how it didn't solve the problem that most successful investors said that they look for, is he decided to focus on a protective put position. Now, many of you who have read any free information at your broker or any free online information are familiar with the married put or protective put position. It's typically defined as buying stock and buying a put option. However, when you're looking to analyze a put option to purchase, the free materials you might read suggest that you're buying a put option that is just 1 month out in time, maybe 30 to 45 days out in time, and out of the money. So if I bought a stock at 50 today, let's say $50 per share today, I might be considering buying an October 45 strike put. And that 45 put guarantees me that I can, in the worst case scenario, if the stock collapses, I can sell to close my shares of stock at 45. Since I'm only buying an October put that's out of the money and has no intrinsic value, I might only be paying 80 cents or maybe $1 for that particular put. Now the problem with that setup is the stock needs to drop 5 points from $50 to $45 before the insurance policy kicks in, and I paid the dollar for the position. So I'm really risking $6 on about a $51 investment. Now that's much over 10%. That's kind of close to the 15% range of risk, and that can still get you into trouble. If you enter positions that have a maximum risk of 15% and you're taking some losses here and there, and you're only making 6 or 7% when you're right, or maybe even 8% when you're right, you're in a position where you still have to be right more often than wrong. And that's common. If I'm in covered calls, I have to be right more often than I'm wrong in order to make money. Even the standard collars that I sometimes trade, I have to be right more often than wrong in order to make money. But there's a better way. And as Kurt looked at positions, as he started talking to investors who bought calls and bought puts, different strategies, what he learned is that just about any investor who buys calls or buys puts for speculating on market direction is going to buy a call or put that's several months out in time, maybe 5 to 6, maybe even 10 to 12 months out in time, to give the stock more time to move in the desired direction. Typically, they were also buying in-the-money calls or in-the-money puts, those that were speculating on market movements, trying to take advantage of leverage. And so what Kurt started to look at is, what if I followed the general principle of the protective put, married put position, but instead of buying an out-of-the-money put that was just 1 month out in time, I decided to buy an in-the-money put that was several months out in time. Now this gives us the risk reward we're looking at. This is what we want to see. It is a bullish position. Okay? The blueprint discusses 10 different income methods where we can adjust this risk. We can lower this at risk, whether the stock is trading up, whether it's stagnating, or whether it's dropping down in price. There are different income methods for different market movements after you've opened the married put. But the initial setup is a bullish position. We are expecting and we are looking for stocks that are moving up in price. The risk, of course, is safer. We have a guaranteed floor in the position. We have successfully entered a position where we've forced ourselves to limit our losses, cut our losers short, but allow our winners to run. And the initial setup forces it in that position. The reward is near unlimited. If the stock takes off, and Kurt has shown examples of this to his efficient subscribers with stocks such as GMCR and I believe Amazon as well, if the stock continues to move up in price, well, you might not even have to do an income method. You can simply just liquidate the position if you've reached your personal goals. So this is the setup that we're looking for. Yes, we are in a bullish setup. The risk is safer. We have a limited risk. We've cut our losers short, and we've allowed our winners to run. We're forcing ourselves into a position that supports that basic axiom that all success for trades. Now, many of you have probably mixed stock and married puts the wrong way. Okay. Kurt eventually blogged about this once he discovered it, and then he informed his subscribers that he was going to try to write a book. Now, that's eventually where the blueprint came from. A few moments ago, I had discussed about how Kurt had looked at that profit and loss chart that we saw with the protective put, and he noticed that the long call was a similar risk-reward profile. Many of you might be thinking about that question. Well, that profit and loss chart we just looked at with a protective put, married put, isn't that the same thing as a long call? Well, the profit and loss chart looks similar, but there are differences. When you use a long call position, you end up falling into the trap of leverage, especially if you don't reinforce proper money management. Now let's take a look at this. Let's assume that you entered into a few trades. Over the next 4 months, you entered into 3 different trades. Would you rather, on those 3 trades, on the first trade you lose 5%, on the second trade you make 20%, and then on the third trade you lose 5%, or would you rather use leverage and multiply everything by 8? So we'll lose 40% on our position, we'll make 160%, and then suffer a 40% loss again. Okay, without getting out your calculators, I don't have a poll for this, but without taking out your calculators, just let me know through the question pod if you'd like to use the left or if you'd like to use the right. And on the left we have lose 5%, make 20%, and then lose 5% again. Or would you rather implement leverage and go through the same 3 trades in the same 2-month period where you'd suffer a loss of 40% but then make 160%, more than double your money, and then lose 40% again? Okay, so just let me know I should say, which one looks better. Now I have 2 votes for the left-hand side there. It looks like Stephen and Mike wants to go with the left-hand side as well. Okay, let's see here. All right, and I've got some other votes coming in as well, of course. Got Dave wants the left, and Ed wants the left as well, and Joseph wants the left. All right, Jonathan wants the left. Okay, so most investors are saying left. Well, you've probably all seen this before, so that's great there. Let's go ahead and move forward here.
Let's move forward then, my man.
Hold on one second, ladies and gentlemen. I apologize for that, ladies and gentlemen. Now, although when we take a position, if we had 3 trading records and we suffered a 5% loss, a 20% gain, and then suffered another 5% loss, this would look like we'd have a net gain of 10%, but it really works out mathematically to a net gain of 8.3%. Now, I did have some votes coming in towards the end to say for the right-hand side, and the problem is if we multiply everything by 8%, if we suffer a 40% loss and then take a 160% gain and then another 40% loss, this results in a loss of 6.4%. Okay, so doing with the leverage, multiplying everything by 8, even though we took a larger gain in the center, this would still result in a 6.4% net loss. Okay, but with taking just a 5% loss, a 20% gain, and then a 5% loss, this would lead us to a net gain of 8.3%. Okay? And, of course, Kurt always says that you may argue that the 6.4% is based on the 1/8 capital. That's not too bad. But then if we did everything else, if we just multiplied that by 10, if we did a 50% loss, took a 200% gain, and then suffered another 50% loss, this would result in a net loss of 25%, of course, not including commissions. So this is how the leverage can work against you. All right? And this is why the trading long calls we advocate is not the same way. Now, Kurt discusses this more in depth in the blueprint, and if we have time at the end of the presentation, after we show some of the other materials, some of the other discussion, and the income methods that Kurt promised everyone, I may jump into just a base comparison that we ran a couple weeks ago during a webinar comparing the long call to the married put position. But all right, this is why we advocate, even though the profit and loss chart looks similar, why we don't advocate it. Because the lie of leverage can be used against you. When we use the married put position, when we buy stock, when we buy a put option for protection, making sure we limit our risk to only single digits, we take advantage of one of the 3 core principles of radioactive trading, and that's force an ideal size trade. So when we originally open a married put, okay, we have a position where we've limited our risk, we have the upside profit potential, and the break even here. Okay, now what you're looking at here with the married put setup, this profit and loss chart here for the RPM is the position at expiration. When we open the married put, when we do it radioactively, we're going to buy a put option that's very far out in time and in the money. Now that put is not going to decay one-to-one with the stock. As the stock moves up, we're not going to lose one-to-one with the put option. But this is the profit and loss chart that we'd see at expiration. If I held that put all the way to the expiration date, made no adjustments on the position, and the stock was trading below my protective put strike price where the elbow is here, yes, I would suffer the full loss in the position. But as we're going to see in just a moment, we take a look at the profit and loss chart of a standard RPM when we set it up. The curved line at the halfway point, or when we first open the position, we're not going to be down 5, 6, or 7%. And in fact, when we first open the radioactive profit position or the radioactive profit machine, even after a couple days, we could probably liquidate it for only a 0.1 or maybe a 0.2% loss. When we open the position, we're really only risking the difference in the bid-ask spread on our position, on the put setup. All right. Okay, well this is good. This is going to lead us right into the SLW trade. But before I get into the income methods that we did for SLW, I'm going to ask what type of income methods you would like to see. But here's a standard RPM setup, a radioactive position setup. It was done on May 21st, 2010. And on May 21st, we got filled on a couple hundred shares, a few hundred shares, about 300 shares of silver Wheaton at $17.20. At the same time, we purchased the December 2010 20 strike put for $4.30. So we're at May, a little bit after May expiration, going into the beginning of June, and we purchased a December put. So this put was about 6 months out in time when it was purchased, really. About 7 months, actually, because the expiration in December was around the 18th or 19th. Now, stock's at $17.20, and we purchased a 20 strike put. We didn't purchase a 15 strike put or a 12.5 strike put that was out of the money, because that risk would have been too high for what we're looking to accomplish here. To force ourselves into an ideal size trade and not fall into the trap of gambler's ruin, we only want to risk single digits on each of our positions when we open them initially. Now, the cost of the 20 strike put was $4.30. So my total invested after buying stock at $17.20 and buying the December 20 put for $4.30 was $21.50 per share. But remember, I'm guaranteed an exit at $20. What we just saw in that last little profit and loss chart there, I have a floor set, so even if the stock's trading below $20 on December expiration, I've made no adjustments. The maximum at risk would be $1.50. That's the most I could lose per share, which works out to be about 7% of the total position. Now the position was opened during this decline here, during this pullback here. That's about when we opened the stock. It got in at about $17.20. And of course, afterwards the stock had moved up. And what we're showing here, the August position there at around $19.50, that's where the stock ended up going. Now, before I go into this, I'll just show this quick income method here. Let's go back one slide. I apologize for that. Sorry, folks, I apologize for this. I don't like these slides that have the timing in it. What we're going to look at is as the stock moved up, at around June 28th, the stock was trading at about $21 per share. And as the stock moved up above our put strike price, remember we had the 20 strike put, but as the stock moved up above that, it corrected later, but then it came back up at around June 28th. That's when we evaluated the different income methods. Of the 10 different income methods, there are about 5 different income methods we were evaluating on this position. On June 28th, this is where we entered the position. And then as we see going forward, as we headed into August, this is where the stock started to, it pulled back a little bit and the stock started to move back up. And the reason why we wanted to show that is because I wasn't going to do an income method here. Remember, this is about where we opened the RPMs, right here on May 21st. We waited for the stock to move up before making an adjustment. I don't want to do an adjustment right away. When we trade radioactively, we're going to wait for the stock to move before making an adjustment. Now, going back forward, on June 28th, we had seen that the stock moved up. And remember, our initial invested was $21.50, and we did have a risk of $1.50 as we had the 20 strike put. Now on June 28th, we sold the August 21st call. We essentially went 2 months at a time. This is income method number 1, selling a call against the position. But when I opened the RPM by buying stock at 1720 and buying the December 20 strike put, I didn't do an adjustment at that time. I waited for the stock to move, and then I looked for an opportunity. Now I could have sold the July 21 call at this time, and it would have brought in about $1. The reason I went with the August is because it was close to my initial risk. Remember, we had $1.50 at risk, and we got filled at the August 21 call for $1.48. So this is going to lower our cost basis from $21.50 down to $20.02. But remember, we're still holding that 20 strike put, and we are short a 21 call. So on the downside, our new risk is only 2 cents. We have a new cost basis of $20.02. Even if the stock moves up to $23, $24, $25 per share, what we're looking at here is that we've lowered that at risk. We keep that $1.48 premium, so our total cost is lowered. So now the maximum risk on the downside is only 2 cents per share. We've almost bulletproofed their position where we end up having no risk. Okay? Now this is how we take the setup. Remember, over here on the left is what we saw with the standard married put position. If this was if we were looking at a profit and loss chart that had our stock prices and our current at risk amount, remember what we'd see here on the axis here is that at the elbow this would be the 20 strike where we had purchased our put, and the maximum risk we'd have here, this would have been $1.50 or $150 per 100 shares. So that's the maximum we could lose on the position would be $1.50. We still have the potential for unlimited upside. Now, we sold that call for $1.48, reducing our risk. So the income methods shown in the blueprint, the design is so that we can reduce this risk, still have potentially an unlimited upside, and be able to take advantage of that. Now, with income method number 1, many of you have heard me say this over time. With income method number 1, we do end up capping our gains. We're going to take a look at that profit and loss chart in just a moment for the SLW position. Essentially, what had happened when I sold this call, did income method number 1, is I did reduce the risk on the RPM here, but then we ended up with a position that looked much like this. So here's my 21 strike call. Here's the maximum risk if the stock collapses below 20 now. So I did cap my gain using income method number 1, but based on my expectations. And the blueprint discusses the SIGA model for each of the individual income methods that can be used. Conditions, your expectations, and your personal goals. Well, when I evaluated this, I wanted to get close to bulletproofing SLW, and I was under the expectation that the stock wouldn't be trading too far above $21 at August expiration. But if the call had expired worthless, or even if I was able to buy it back cheaply, I would have successfully reduced the initial at risk and then still had advantage of the unlimited upside profit potential after the call either expired or I bought it back cheaply. And then if I perform a second income method, this is the ultimate goal. If we haven't reached our personal goals for the position, we haven't liquidated yet for the personal goals, what we would like to do is remove that risk entirely. So we have a position. What happens when I lower my cost basis below $20 per share? Let's say my cost basis is only $19 or $18, and I'm still holding that $20 put. Well, that means that I'm still guaranteed, even on the downside in the worst case scenario, to make $20, and I've managed to lower my cost basis to $19. So I'm guaranteed a profit of $1 in the worst case scenario and still have the unlimited upside. And that is eventually what happens with the silver Wheaton trade. Now, we don't want to go to the slide. Question for you, and you can use the question pod to fill this in. We just showed income method number 1. I can continue on with the silver Wheaton position if you wanted to look at that, but I also have an example of a Humana trade that Kurt had put on where he shows income method number 4 and income method number 6. Income method number 6 is one of the spread trades that does not add risk, that can be applied to the RPM to reduce the risk and leave your upside open. And then income method number 4 could readjust the position to help you bulletproof it. So for the last 20 minutes or so of this presentation, would you like just vote in with the question pod, because again I don't have a poll on this, but just vote in on the question pod if you'd like to see the rest of the SLW trade, or if you'd like to take a look at the Humana example that showcases income method number 4 and income method number 6. So just let me know. All right, I've got Stephen and Michael saying they would like to see the Humana trade. I've got different Mike saying that he wants to finish the SLW trade. Okay. All right, so far I've got a 50-50 split on this. Okay. So let me do something very quickly here. Let me find out where I need to be. Just give me one moment, ladies and gentlemen. Let's just go through both without rushing it, shall we? There we go. Let me open this one as well. I'm going to open another presentation here. I apologize for the delay. Let me just get to where I need to be here. And of course, we'll just go ahead and do both of them very quickly. I won't rush through them, but we'll do both of them very quickly. So here, I just want to get to where I want to be. Now, with Silver Wheaton, what ended up happening, and I'm going to show the screen in just one moment, so just bear with me. I apologize for this, ladies and gentlemen. All right, so let's go back to the Silver Wheaton trade. We remember the initial setup. And here's what I was talking about before with the profit and loss chart. On the Silver Wheaton trade, we had the gain here. I'm sorry, we had the limited risk, but then we see that curved red line, the curved red line on the profit and loss chart. That's more of the profit and loss chart at expiration, or at the halfway point, not at expiration. Okay, so you see that even though the break even here at expiration, crossing our blue line, was if Silver Wheaton was at 21.50. But notice at the halfway point, which would have been around November 16th, we could have realized a profit if the stock was trading right at 20. And this is the advantage of using that far out in time put, because it does not decay one-to-one with the position. Now here's just the breakdown of what we already saw. Income method number 1 sold the August 21 call at $1.48. And this was how that profit and loss chart looked. Remember, we had a risk of only $2. Oh, I apologize. Let me get back. I apologize, Imogen. After income method number 1, this is what we were looking at with the Silver Wheaton trade. So that we were only seeing, we had a capped gain on the position, but we did essentially have it bulletproof. We were risking only that $2 per share. There we go. Okay, so we were only risking that $2 per share. And we had a potential gain of 11.6% if the stock was trading right at 21 at expiration. And this was, remember, August expiration. Okay, so what ended up happening at August expiration? I held the call as long as I could because the stock was trading above 21. It pulled back a little bit on August expiration, kind of went the way I wanted it to. So what I ended up with is we'd sold it for $1.48, and we ended up buying to close the call for about 3 cents. And this is not including commissions right now, but we can talk about that in a little bit later. It actually didn't affect the profit of the position too much. Now, I'm still going to retain a premium of $1.45. Remember, we collected $1.48 and buying it back for 3 cents. So of our original $1.50 we had at risk, we're going to keep this down now to just 5 cents. So we had $1.50 at risk, managed to reduce it by $1.45, so we keep that down to 5 cents, and this should be 0.3% of our total investment. After the call was closed, this is how our married put, our RPM would have looked. We have a limited risk, and we have the unlimited potential upside still on the stock. And we're at August 21st now, and the stock's trading at about $21.01, $21.02. Now, this screenshot, of course, was taken when Silver Wheaton was up at $26.44. But after the call was closed, this was our profit and loss chart. Now, common mistakes with income method number one, and Ralph asked a question that I will address. When I had entered this trade on May 21st, 2010 on Silver Wheaton did not offer weekly options. It does now. Okay, the SLV and SLW both have weekly options, if I'm not mistaken. Or maybe just SLV does. But in any case, the common mistakes with income method number one, and you may think I'm belaboring this, but I see too many people attend a free webinar here at Radioactive Trading, see how we do the setup to limit risk by buying a put that's 6 months out in time, where our risk is no more than 5 or no more than 7 or 8%, I should say. We're not going too deep in the money where we don't have any potential of profit, and then to say, okay, well, I know how to sell a call, so I'm going to open the RPM as Kurt showed during the free presentation. I'm immediately going to go ahead and sell a call against it. Well, that's a problem. You end up increasing your risk on the upside in the direction you thought the stock was going to move. So the common mistakes with income method number one is selling the call too soon. You don't want to do that. You want to wait for the stock to move up in price, and you never want to sell a call below the put strike price, especially if it's your first income method. And again, the reason why is because with this investment on Silver Wheaton, remember I had $21.50 invested and I was holding a 20 strike put. The stock was at $17.20. If I had sold the $17.50 call for maybe $1 right away, well, on the downside, that would have reduced my risk to only 50 cents if the stock collapsed. But if the stock moved up to $21 as it did, it might cost me $3.50 or $4 to buy to close that call, so I'm actually adding a lot of risk into the RPM. The other problem is I had $21.50 invested. I sold a 17.5 call. So if the stock moved up to 20, I'm no longer gaining positive delta because the short call is hindering the gain on the upside. So we waited for the stock to move and then sold a call that was equal to or above the put strike price. And you never want to sell a call with too little premium. Now, Ralph's question was, do you ever sell the weekly options against the RPM? Yes and no. And the blueprint makes that really clear. Not so much in the weekly options, but what you're looking for. There are certain rules of thumb that you want to follow when applying income method number one to the position. Number one, I want to wait for the stock to move so that I can sell a call that's equal to or above the put strike price. I can't plan on selling a weekly call necessarily. I can't open the position and say, okay, I want to sell a weekly call because it might not be the right time. If I am trading a security that offers weekly options and I see a weekly option that has enough premium, now that the stock moves up and the call is equal to or greater than the put strike price, I may choose to do that. Kurt has tried to set up RPMs in the recent past on things such as Baidu and I believe Amazon that offer weekly options, and he found that it was difficult to say, well, I'm going to try to sell it every week because it might not be the right time. And if you do the income method at the wrong time, you can actually increase your risks in the direction that you want it to go. So Ralph, you can sell weekly options, you can use the weekly options for the income methods, but it's difficult to specifically plan that you're going to sell a call or do an income method month by month by month by month. Or my apologies, ladies and gentlemen, week by week by week by week, because it might just not be the right time to implement that technique. And you might not want to add any risk to your position by forcing yourself into a bad income method. All right. So general rules of thumb, we just reviewed this. Wait for the stock to move up in price before looking to apply one of the bullish income methods. And the blueprint tells which are the bullish, which are the bearish, which are the neutrals. And the general rule is you want to wait for the stock to move up 5 to 8% after your purchase price. And the best opportunities occur when this stock is trading right at the put strike price. That takes advantage of a second core principle of radioactive trading. The first was forcing an ideal size trade that we saw with that setup where we force ourselves into a limited risk position and we allow the upside to run. The second is the at the money bell curve, where we want to buy options that are typically in the money when the time premium is low, and we're going to sell options that are at the money once the stock has moved up in price to get the higher time value. All right, now what? Well, SLW continues to move up in price. Once it moved up, we use the power options tools to evaluate, well, which income methods, what's going to happen with these different income methods. If I did income method number 1, I could simulate that trade. I did income method number 4, I could simulate that to see if it matches my criteria, or even income method number 6, which we'll take a look at in a couple minutes. Okay, so we had decisions. Now on August 27th, a week or so after August expiration, we had lowered our cost of just the stock. Remember, we bought shares of stock at $17.20. we essentially kept $1.45, so the effective cost per share on the stock had been lowered to $15.75. And we still had a December 20 put at 430. Remember, so that gives us our total investment of $20.05, guaranteed $20. So we're risking 5 cents or 0.2%. Now, income method number 4, which takes advantage of the at-the-money bell curve, the stock was trading again at around $21, and we have a December 20 strike put. Actually, I'm sorry, it moved up to about $22.50 at this time. So with income method number 4, what we want to do is adjust our insurance policy. And by adjusting our insurance policy, what we're going to do is we're going to sell to close the put option that we own. Now that it's at the money, now that the stock's trading right around $20, $21, maybe $22 per share, we're going to sell to close the December 20 put for $110. Now, without even considering income method number 1, let's just take a look at what has happened here. Okay? When we first opened the position, we had bought stock at $17.20, and we had bought our December 20 put for $4.30. But the stock was at $17.20, and we bought a 20 strike put for $4.30. So a lot of that was intrinsic value that we had paid for, and in fact, we were only paying our at-risk amount. That $1.50 at risk was the time value. That was the only thing we were risking, was the time value of the put option, or $1.50. We've now moved from May to August 27th. Okay, so we've gone about 2 months, from May 21st to August 27th. Actually, it's more like closer to 3 months out in time. And notice here, the December 20 put is now out of the money. The stock's trading at around 22. But I still have $1.10 in time value. Did I lose intrinsic value on that put option? Absolutely. We had paid $4.30 for it. It's only priced at $110. So you could say, oh, you lost $3.20 of time value on that, or intrinsic value on your put option. And that's exactly right. But now that the stock's at 22, remember, we had bought stock at $17.20. So we've gained about $4.80 on the stock that we're holding, and we lost only about $3.20 on the put. The put does not drop 1-to-1. So we still have $1.10 of time premium. What we're going to look to do is sell to close the December 20 put for $1.10. All right, so remember, we paid $4.30, sold it for $1.10. Oh, sorry. Paid $4.30, sold it for $1.10, so we technically at a loss of $3.10 on the, or $3.20 on the position. This puts our cost per share back to $18.95. Remember, we lowered it down to about $15.75. We're moving it back to $18.95 just on that put. But at the same time, we're going to buy a December 24 put. So we're taking advantage of the time value we still have remaining on the 20 put, and we're going to buy a December 24 put for $2.70. Now our cost basis on the stock had increased to $18.95. We're going to add $2.70 to buy new insurance, so our total cost is $21.65. But what have we done? We've guaranteed a higher payout at 24. So we have $21.65 invested in the total position. We're guaranteed to be able to sell to close our shares at 24, so this gives us a new at-risk amount of negative $2.35. A negative at risk means a bulletproof position. Okay? And so right now, the position is guaranteed a return of 10.9% in the worst case scenario. This 10.9% would only, I would realize this 10.9% is the worst case scenario only if I held the position all the way to expiration, again, December expiration, and the stock remained below $24. Right now, I could liquidate the entire position, stock plus the new put, for a much higher gain when that had happened. So again, here's our trade-off. We had lowered the stock cost basis down to $15.75. We had purchased our 20 strike put for $4.30, sold it for $1.10, because it still had time value remaining. It didn't drop to zero, and bought a new December put at a higher strike for $2.70. So this puts our maximum risk at negative 10.9%. You see down here, that's the worst case scenario. That 10.9% guaranteed profit occurs only if I still decide to hold the position all the way to December expiration, make no adjustments, and the stock's trading below $24 per share. The stock continues to move up, I can realize more profit. And again, the curved red line, 1116, you'd see even if the stock stayed at 24 on November 16th, we'd realize a much higher profit than $235. Probably be around $400 there, maybe about $350, $400. So this guaranteed profit is worst case scenario. Right now, on August 27th, when I made that adjustment, I could still liquidate it for a higher gain than 10.9%. Okay. Now, in September going forward, we didn't want to belabor the point. We did another income method number 1, where we sold the call for about $2, and then we ended up buying it back for around 30 or 35 cents on a pull. I'm sorry, $1.30. So we generated 70% of premium, which lowered again the effective cost per share of just our stock from $18.95 down to $18.25. On September 8th, we just did this on the 27th, and SLW continued to move up quickly. We used income method number 4 again. On September 8th, the stock was trading right around 25. So again, we sold to close the December 24 put for $2.20 and bought to open a December 27 put for $4. Now what's the trade-off here? We're essentially trading off. We are paying a debit. That's the important thing to notice about income method number 4. It's essentially the only income method that is done at a debit. I'm paying $1.80 to adjust this position, to sell the December 24 put when it's roughly at the money, and buy an in-the-money December 27 put that has lower time value, but it has more intrinsic value. So I'm paying $4 to close the December 20 put, and I'm getting $2.20 for selling to close the December 24. Now, I'm paying $1.80 out of pocket for the right to get $3 back, to reinsure my position at $3 higher strike price to pay $1.80. So that's essentially just like generating another $1.20 in income. I'm not doing that directly, but it's giving me $1.20 better. So again, after the 70 cents of income method number 1, we lower our cost basis down to $18.25. We had a December 24 put at $2.70. We sell to close that for $2.20 and buy to open the higher strike for $4. Our new cost is $22.75, $22.75. I'm adding to my cost basis, but now I'm guaranteed to get 27 back. So now we've locked ourselves into a higher gain. If the stock trades, and the stock was right at the money, it was around $27 per share. If the stock's trading below $27, again at December expiration, we're guaranteed to make 18.7%, still have a higher unlimited upside if the stock continues to grow, which is what happens. But you see the curved red line here again at 11.16. If the stock was trading at $27 on 11.16, we're going to make more than that $4.25 that we're guaranteed. This guaranteed exit is, again, if we still hold it to December expiration and make no adjustments. All right. And as we continue on November 4th, silver Wheaton's now at $32 per share. We use income method number 4 again. Now this was a bad choice on my part. And for those of you who have the blueprint, you can kind of see why. I waited too long and the stock continued to move. I should have done this other income method number 4 if the stock was trading around $28, $27.50, maybe even $29. It would have been better to do that in October when the stock was trading at that price. Instead, I waited, and what I did is I sold the December 27 put when it was out of the money, so I only got 52 cents for closing that, and then I bought the March 32 put, which was at the money, for $3.80. Now, this still is a benefit to my position. Why? Because if you look at this, I really only paid about $3.28. Okay, so I'm going to pay a debit of $3.28. I paid $3.80, subtract 52, that puts us at about $3.28 for a guaranteed 5-point higher payout. So it's net debit of $3.28, a higher payout of $5. So we're still generating a positive effect for our position. We're still getting a higher guaranteed exit. And now the position again is essentially more bulletproof. Here's just the basic setup. We've taken our cost basis now up to $26.03, but we're guaranteed a payout of $3,200. So now, and what we also did is we went to March. Okay, we also not only extended a higher strike price, we gave ourselves more time on the position. So now our worst case scenario is that we're guaranteed 22.9% of profit, still have the infinite upside, but again, that 22.9% is the worst case scenario. If I hold it now all the way to March, make no other adjustments, and the stock's trading below 32, we're guaranteed a 22.9% return, or about $600 on an investment of $26.03. Now, just to wrap up on this particular one, what ended up happening is that SLW continued to move up, and it was trading at 36. We had the 32 put. We were contemplating doing another income method number 4 to roll to the March 36 strike. This would have guaranteed a 28.9% return on the position, but what we saw is the stock pulled back over the next few days. Now on November 29th, SLW, it pulled back and then it moved back up to 36. We evaluated the sim income method number 4. It was close to it. It was about a guaranteed return of 26%, still with the unlimited upside. Then on December 6th, it just continued to rise from November 29th to December 6th, and it closed above $40 per share. And this about was our target price for closing. And on December 7th, it opened above 42 and then fell in price. And essentially what we decided to do was exit the RPM at this time. We still had the March put. We still could have continued to trade it, but it reached the goals and it extended our expectations. So at this point, I decided to close the position. Now here was just the wrap up. After all the income methods, we eventually put the stock, cost basis for the stock was 22.23. We were holding that March 32 put at 380. So we had our total investment at 26.03, guaranteed by the put of 32. So we have a guaranteed return of 597 or 22.9%. Now what we ended up doing is we ended up doing an alternative income method number 4 that I'm not going to go into right now. But when we closed the position on 12/7, we received $40.30 for the stock. Our March 32 put still had $1.30 left of time premium, so we took in $41.60. And but remember, let's not take a look at that right now. I wanted to go out here. Let's see. Okay, here was the essential closing part without going into the alternative of income method number 4. The alternative for income method number 4 is discussed in the blueprint. We don't want to get into that right now. So the summary was the RPM was open on 5/21 and was liquidated on 12/7. That's 139 days in. The maximum risk was never higher than 7%, and the position was bulletproof in about 35 days. Remember that first adjustment with income method number 1. So we combined income method number 1 and number 4 over time to lower the at-risk and further bulletproof the position. Now, the liquidation profit on 12/7, when we originally still had 26.03 left in the position, remember from that last income method number 4, our total in was 26.03. And when we closed the position, we took back about $41.60. So the total profit per share on the position was $15.57, or 59.8% over that 139 days. Now, what we tend to focus on is not important to focus on the return. That was a great return, but this is not common. This is not what we normally see. Silver Wheaton extended our expectations over that time. When we opened the position, the at-risk amount was never more than 7%. And in less than about 40 days, the position was bulletproof with that first income method number 1. Now remember, we don't want to overtrade. It was not necessary to apply an income method if it does not match your SIGA model. There were other opportunities when the stock was moving up and down where we could have adjusted Silver Wheaton, but we wanted to wait. And what we talked about before with looking at that income method number 1 is we didn't want to do it right away because we wanted to wait for the stock to move up so it matched the SIGA model. And Michael wanted to know, I believe that's Michael, I apologize here, let me take a look. Michael wanted to know what does SIGA stand for? It's in the blueprint for not only the RPM setup, but each of the 10 income methods. SIGA is an acronym for the decision-making process when you enter an RPM or are choosing to do an income method. It essentially stands for what are the current conditions of your position, or what do you feel the conditions are in the market? What are your expectations for the underlying stock? That's really important when evaluating which income method is best for you. What are your personal goals? And which action would you take? Right? So the S, the C, the E, and the G sort of lead you to what is the action in the final process, and that's what SIGA stands for. You want to be patient. Do not feel you have to use an income method just because one is available. As you're using the position, as you're tracking the positions in the Power Options portfolio, you can link to a position analysis screen that will show you some potential income methods and have the math done for you. They're not recommendations or suggestions, it's what you could potentially do. So don't feel that you have to use an income method just because it's available. Write out your goals and expectations, and this is all described in the blueprint. And one of Kurt's favorite sayings, of course, is don't try to time your trades, trade time. All right. Now, unfortunately, it doesn't look like we're going to have time to go into the Humana RPM at this time, or there's different income methods for Humana at this time. It's because we're past the 1 o'clock hour and we want to wrap up here. Just want to show a few things very quickly, and I'm actually going to show you where you can take a look at some of those other views as well. Okay, let's take a look here. Let me go over here. All right, so one thing, let me ask this real quick. I've been talking for a while now. Let's see here. Remember our initial setup when we talked about the silver Wheaton trade, and we talked about, I apologize, what we were talking about doing is we're starting off at a position where we have a very limited risk, single digits of 5 to 6%, and we're going to use the income methods, the 10 different income methods. Income method number 1, of course, 3, 4, 6, and 5 are typically used in a bullish market. If the stock is stagnating, income method number 7, 8, and even 6 can be used. And if the market falls, you can take advantage of income method number 6 as well, and income method number 9. But think back to that previous poll for me where we had 10% of you, I'm sorry, I apologize, 5% of you say you were very happy with your results. 21% of you said that you were happy but could be happier. 58% had mixed emotions, 11% were unhappy, and 5% were ready to quit. Now let's talk about this. Keep in mind all of the wins you had over the last 12 months. And what would your answer have been to that poll we just asked, that poll we asked earlier? What would your answer have been if you kept all your wins from last year but limited your losses to single digits? Okay, so let's think about that. What would happen if you had limited your losses to less than, let's say even less than 7%, okay, 6 or 7%, kept your losses less than 7 or 6%, kept all your wins from last year? How would you have answered that previous poll? Would you have been happy with your trading results? Would you have said, had you originally said no or mixed emotions, but this would have made you say happy? Would you had a losing year last year, this would have made it into a winning year if you would have kept your losses to 6%? Or would you still have lost or lost much less? All right, so some of those answers are coming in. All right, had this poll open for about 55, 56 seconds here. I'm going to leave it open for another 10 seconds, so if you haven't voted yet, go ahead and get your votes in. All right, let me go ahead and close the poll, ladies and gentlemen, and I'll share the results from everyone. Now remember what we saw before. 5% said they were happy and ecstatic with their trading results. 21% said they were happy with their trading results over the last 12 months but could be happier. 58% said mixed emotions. 11% were unhappy and 5% were ready to quit. Now if you had just applied that one simple process of using the setup of the married put for the long stock positions, so you limited your risk to 6%, 47% of you would have been happy with your trading results over the last 12 months. And that's much better than the 26%. Even if we took the 5% that said yes and the 21% that were happier could be happier, 18% of you said that you had said no or mixed emotions, but would have said that you were happy. So now we would have had over 65% of you saying that you were happy with your trading 65% of you would have been happier with your trading results over the last 12 months if you just kept your losses to 6%. 24% of you had a losing year, but this would have made it into a winning year. That's fantastic. I mean, now we're essentially up to 89% of you would have done much better with your trading just by implementing that one basic setup, that one thing we gave away for free today, by keeping your risks down to 6% on your position, 6 or 7%. And 12% would have lost or would have lost much less. And that's great. You know, I mean, still, I mean, even in, I'll be honest with you guys, for the course of, while I was trading radioactively, over the course of 2008, I was long stock. And on my RPM portfolio, where I was doing the long stock positions radioactively, I had stocks that were down 40%. I had one stock, Office Max, that had dropped 72% over the 5 months I was holding the position. That Office Max position, I was able to close for a gain of about 1.2, 1.6%, I think, by using the different income methods. And that was a unique position. The other stocks I had that were down about 40%, 45%, while being long stock over that time, I only lost 4%, 2.5%. I was able to adjust it to cancel some of that risk. Overall, during that time when the market, a lot of stocks were down 35 to 40%, my whole RPM portfolio, the radioactive portfolio that I was trading, I had about 6 positions in, was down only 4%. Now what does that mean? That means I would adjusted the positions. I still kept 96% of my capital and could buy more positions at the bottom if I thought we were going to move back up, or stay in the positions I had because I couldn't lose more than 4% or 2.5% and take advantage of the return as we came out of that decline over the 2008 to 2009 and into 2010. So that's what had happened. That's what's possible. Right? But this just shows me that pretty much close to 100% of you that voted would have had a much better trading result over the last 12 months if you just followed that simple rule of using the put options, in the money put options, to keep your risk down to 6%. And I do apologize here. SER, I think it was Sergio, was it? I believe it was Sergio said that he's just getting started. He doesn't have an experience, so he can't answer. Well, that's okay. But think about it this way, Sergio. All the investors online today, about 60 of us started out, and we've still got about 48 online with us. But of those, originally, only 26% were happy with their trading results. Remember, we had 30% doing covered calls and naked puts, 30% doing long calls and long puts, and 70% doing spread trades when we launched that initial poll. Of those results, only 26% were happy with their trading results over the last 12 months. And if we had just implemented, of those, if we take a look at it, of everyone online, if we had just implemented this idea of limiting their losses to less than 6%, we're now looking pretty much close to 100% of our audience would have been happy with their trading results. All right, now we're going to move on real quick here. I had a couple questions come in. Now, Lloyd wanted to know, Mike, I didn't see can I get a copy of the silver Wheaton trade? It's not in the blueprint. Well, at any time, and this also goes for those of you who wanted to see the Humana income method number 4 and income method number 6. We did show income method number 4 with SLW, but if you wanted to take a look at income method number 6, if you go to radioactivetrading.com and go to free webinars and podcasts, you can take a look at that Humana trade right here, comparing hedge strategies, RPM basics, income method number 6, and income method number 4. So when you have the time, just go to radioactivetrading.com, click on free webinars and podcasts, and you can take a look at that Humana position at any time. And Lloyd, right here, if you wanted to take a look at it again, you wanted to review it in your spare time, the income method, the silver Wheaton trade we just showed, income method number 1 and 4, is available in that free webinars and free webinars and podcast archive as well. All right, so you can watch those two at your convenience. The Humana trade that we are going to try to get to today, but we've gone over time, and I apologize for that. That's available, comparing hedge strategies, income method number 6 and 4, and you can review the SLW trade at any time for 12/9/2010. All right, 5 seconds of commercial. Now that we've gone over this, remember we'll always have free webinars on Tuesday and Thursday at 12 noon Eastern Time, but let's talk about the blueprint. We give away a lot for free. Kurt's sentiment is that if you give away a lot for free, then people are going to trust you and they're going to be able to see the power of what you're trying to teach. So we give away some basic examples and some views of the different income methods. What I showed you on Silver Wheaton, the presentation we did, I even shared with you some of the rules of thumb that are discussed only in the blueprint for income method number 1. You don't want to sell the call too soon. You can't sell the call below the put strike price, for example, and you don't want to sell it for too little premium. But the basic offer, the only place where all 10 income methods are discussed, and the specific ins and outs of how we set up the radioactive profit machine, what sort of rules and guidelines we look for with selecting the stock and selecting the put, and how Kurt selects the stocks, I should say. Because the great thing about this technique is it's really not a step-by-step procedure of always buy stocks if X plus Y plus Z equals B, and only enter puts where this is true. That's not really it. You can use this on top of the stock selection process you're already using. but you still want to make sure you're putting the puts in the right position, that you're using the right type of puts, using the right time frame, and using the right one in the money, for example. Okay, and what we're looking at here, the blueprint, of course, is the only place where that's discussed. It talks about entering into the RPM position and how to enter the 10 different income methods and the SIGA model for each of the 10 different income methods. This is over 250 pages, 10 income methods, a special chapter on combining income methods as well. And here's the offer. The blueprint is $339 plus $11 for shipping inside the U.S. It's about $41 international. But what you receive with the blueprint, in addition to all of that information on how to apply the radioactive techniques, is you get a free bonus the first month of fission, where you can look over Kurt's shoulder, look at Ernie's trades that he's done radioactively. It's usually $59, but you can get your first month of fission for only $10. You will receive a free Foundations of Radioactive Trading CD. This discusses the 3 core principles in detail that we sort of touched upon this afternoon. It's an $89 value. That's yours for free when you purchase the blueprint. You'll receive 1 free month of power options. We didn't get a chance to go into the power options tools, but we did show some of the profit and loss charts, some of the screenshots there. And there's also free webinars on the radioactive trading where you can see the power options tools to evaluate that. So the free month of power options, it's an $80 value. And it comes with a 100% satisfaction guaranteed. You purchase the blueprint, you can keep the bonuses as well, that first month of fission, the Fort CD, and your month free of power options. But if you're not satisfied with the material, if you don't think that material really spelled out for you, which it does, I don't know why you'd return it, but if you feel that it's not for you, that you're not set with what you saw in the blueprint, then send it back to us, and we'll refund your money, no questions asked. Okay? So that's a bulletproof trade, isn't it? And purchase the blueprint. If you're not satisfied with it, send it back. You haven't lost anything, and you can even keep the free bonuses there. Okay, so this is that's the offer there as well. And then we also have some of the Mastery Series CDs. Now I want to encourage everyone also to follow along with Kurt's discussion. You know, radioactivetrading.com. Take a look at those free webinars and podcasts. You also want to take a look at the blog. Follow along with Kurt's recent discussions. And then, of course, on the products page, that's where you can buy the blueprint. And, of course, next Thursday at 12 noon, we'll have another free presentation. Steve wanted to know, when was the blueprint updated last? Steve, I believe the last round of updates went through about maybe March or April. I think we're on edition number 9. I don't have it in front of me, but I can let you know after the webinar ends. Jerry wants to know if this is going to be archived and how will it be titled. Jerry, I did record this presentation. I'm going to process it. I'm going to format it. I don't know if I'm going to include it in the archives yet. I probably will include it in the archives, Jerry, just because you asked. I might just rename it SLW trade. Since we already have SLW, an older version of it, which showed the whole trade, but it was back from 12.9, I might just replace that one and call this RPM setup with income method number 1 and number 4 SLW trade. How about that? And that'll be the newest archive. So Jerry, yeah, most likely I'll put it up there and I'll have reference to income method number 1 and 4 and the SLW trade. All right. Jerry, it probably won't be up until later on this afternoon, potentially around maybe 4:30 this afternoon, depending on how my schedule goes, because I have to format it, turn it into a different file, and then upload it. Okay? Yeah, it'll be right there as soon as you, later, 4 o'clock, 5 o'clock today, click on free webinars and podcasts, and it'll be the first one listed, and it will have the, it'll have reference to SLW income method number 1 and number 4. Today, maybe around 4 p.m., 5 p.m. Eastern. Mike, thank you for joining us. I'm sorry, guys, I didn't get a chance to go into that income method number 4 and 6 on Humana, but remember, you can review that anytime. Just go into free webinars and podcasts, comparing head strategies, RPM basics, income method number 6 and number 4. And we'll probably replace the old income 1 and 4 SLW position with the new one. And that'll be available later on this afternoon. Ladies and gentlemen, I apologize that Kurt could not join us today. I hope you got some useful information. I'm sorry I had to struggle a little bit. This is the first time I've tried to put 3 of Kurt's different radioactive presentations together into one, so I had to stop occasionally and then move on time by time. And Mike, thanks. Yes, I also, of course, do host other webinars during the week for power options, and every Friday at 4:30 I do host the Open discussion and an open forum presentation as well. All right, folks, I hope you have a fantastic day. The Tuesday following Labor Day, I hope you had a great weekend as well. And we hope to see you on Thursday. Take care, everyone. Have a great trading day. Happy trading. We'll talk to you soon. Good night.